A stop order is an instruction to your broker to execute a trade when the market price moves past a particular level. Here's how it works. A stop-loss order is a type of stop order that is recommended for any live position. It's designed to limit potential losses. When the market moves against you, the stop-loss order removes you from your position at a preset level. Always have a stop-loss order in place for any existing position to protect against sudden market news or data releases. For example, if you own stock XYZ at $27 and believe it could reach $35 but your strategy is invalidated below $25, you'd set a stop order to sell XYZ around $25 or slightly lower. A stop entry order is used to enter the market in the direction it's currently moving. For instance, if stock XYZ has been moving sideways between $27 and $32 and you expect an upward breakout, you'd place a stop entry order above the current range high, $32.25, to get into the market once the range is broken to the upside. Stop orders help manage risk and capture opportunities based on price movements.